here we are with my favorite topic of Asia and China. So here is something that I wanted to talk about, and I just got I was tweeted at by my good friend, energy blogger, and he gave me a nice shout out. So thank you if you're watching this for giving me the hat tip on talking about China and the issues that we're gonna discuss. But Bloomberg has this chart that shows credit stress, and they show it for offshore and onshore. And they've moved the offshore stress from a 5 to a 6. So essentially, you're at DEFCON 1, and things are starting to break down, and we're at maximum stress on the offshore side. But they still have onshore at level 2, and which is blue, concerning, but not crazy. My issue is I think that is very understated when you look at the onshore side. And the reason why I say that is because the offshore, the bonds are big, they're ugly, there's a lot of them, but they're easy to see because, again, they're in the open. They're trading in the open market. You can see them, you can touch them, you can trade them. Onshore is a bit harder because I'm not just talking about the onshore debt between a developer and the government. I'm talking about the relationship between the building and the people who bought in. The ones that that took out the mortgage, that put down the down payment. There is way more stress on the onshore credit side when you start looking at the consumer and the relationship to the consumer with the developer. Not so much the others, which is easier to see, easier to calculate, but that is where, and I'm going to talk about why, because you have a lot of people that have come out and said, I'm not paying my mortgage. And everyone's in China, they're like, what do you mean you're not paying your mortgage? It's like, well, I took out a mortgage to buy this. You're not delivering it. Why am I paying you for something that you have yet to complete? So there is, I think, more stress onshore than is given credit in the market, where offshore is easier to see, easier to calculate. Onshore, obviously it's in China, so it's opaque already, harder to see, harder to calculate, but a big an important component when you're looking at not only just what does this mean for debt and credit stress, but what does it mean for global for Chinese GDP, because the consumer is in pain and they're not spending, and we'll talk about that in a minute. They're not spending, and they're not spending. Well, what's making up for the slowdown in industrial production, for the slowdown in exports? And that's where you get some of these pressure points. So foreign reserves dipped. As you can see, it was expected to be at 3.11 trillion, came in at 3.07 trillion as they liquidate more to, again, try to create more of this aggregate financing. PPI above expectations came in at 6.1%. CPI above expectations at 2.5%. And this is what we've been discussing, that inflation is sticky there. And I know it's not going up, but it's also not coming down. And this is when you look at that stickiness and that stagflation. The problem that China is facing, is going to continue to face, how did they export inflation? The whole view was, okay, well, we're going to export it to the international market, try to protect the local consumer. But as exports slow, well, how are you going to recoup this price or this cost? So that's when the government can provide subsidies. They've done VAT tax forgiveness. They've done some of this feedback. But what happens next? And that's where you start to see this. Well, can the government continue to do that? What is the cost? So here, when you look at aggregate financing, they well above estimates. Money supply continued to grow. But when you look at exports and imports are slowing. And remember what we've been talking about, imports are the leading indicator for exports. So exports, you clearly had more stuff going out. Again, this is in dollars or in yuan. So you have the value of stuff going out. But, the value of the stuff coming in is still high. But you're not seeing as much of it come in. So this is where we come back to value versus volume. And the volume is coming down. And if you look at the import data, that's very concerning. That is a very low import number, which is going to point to two things: continuously slowing internal consumption and slowing exports. And that's what we've seen already in the leading indicators, and this is just supporting what we've already talked about. Now, some of the key components of, well, what are they trying to do? So the State Council published a work plan to boost employment through major infrastructure projects. So back to the same things. And the whole thing is they are trying to drum up jobs. So Premier Lee urged localities to deploy more of their economic support funds into labor-intensive infrastructure projects that create a lot of jobs. So you're essentially wanting them to hire likely double the workforce that they need, again, increasing costs, decreasing payback, and likely causing more projects that will be deeply underwater just because you're trying to drum up some jobs where an area that we just don't have those types of projects. The projects that qualify in 7 major fields include transport, water conservation, urban construction. It clarifies the approval procedure. When a government invested key project applies for funds, it needs to provide an estimate of its job boosting impact, and local governments who approve the projects must stipulate the job creation requirements in the approval documents. It orders county-level governments to motivate rural and low-income populations to work for local projects, jointly organize training with project construction firms. It says nothing about profitability. It says nothing about it being a good plan. It is purely a pump for jobs. If they're this desperate to create jobs, just get an idea of what that looks like and the problems that remain on site. So again, there's a big risk of a mismatch in labor demand and supply. These projects mostly involve construction work, but that's not necessarily where the unemployment is. Job losses have also been severe in the service sector. As we've been saying, services have seen negative growth. Manufacturing has seen negative growth for years, not just COVID. And that's, again, some of the problems. In 2021, about 19% of migrant workers held construction jobs, far lower than manufacturing at 21.1% and services at 50.9%. It won't be easy for these projects to woo and retrain unemployed. Government job creation programs are a good idea for lots of reasons, but they have unintended consequences, like creating wrong types of work in the wrong places. For those that are unfamiliar with ghost cities, this is just building for the sake of building, just to keep people employed. And as we said, an economy doesn't implode with 100 ghost cities. It's not 1,000. The question is, when do you hit too many? Is it 1,000, 10,000, 100,000? And that's the problem, is where we reach the point where it is now a massive detriment and the law of diminishing returns bites hard. But this is why when you look at the infrastructure bonds, the quota for new special bonds was unchanged in 2022, but sales happened much faster because they're trying to pull forward some of this. So the Chinese Minister of Finance is considering allowing local governments to sell 1.5 trillion yuan of special bonds in the second half of this year, an unprecedented acceleration on infrastructure funding aimed at shoring up the country's economy and jobs. So again, you're seeing those, but it's the same playbook. The debt would mostly be used to pay for infrastructure spending an old policymaker are using to boost an economy hit by COVID. The funding would add to 1.2 trillion in new support for infrastructure announced over the past few weeks as President Xi Jinping tries to get the economy back on track. It's just, again, law of diminishing returns. Most of these things that were started in 17 and 18, those were some, like 16 saw the best projects. By the time we got to 18 and 19, these projects don't even cover interest, let alone principal. So now you're dumping more money in something and chasing good money, throwing more good money after bad. So what is the missed deadline? So China's offshore bond delinquencies have exceeded $26 billion. You can see that we're already well over 2021, which comes back to, again, that stress point. China's credit market is entering a new stage of its distress cycle as the world's number 2 economy contracts. Payment risk is spreading from private developers to a wide variety of borrowers. Global investors have been hardest hit, not surprising. But delivery delays, and this is the onshore side. Many Chinese cities are seeing delays in completion of new homes, and home buyers in 22 Chinese cities are refusing to pay mortgages on stalled projects. Banks, already grappling with developer defaults, now have to brace for home buyer defaults. With stop-start lockdowns, construction delays are set to worsen. So again, that's the onshore side that is hard to calculate, but that is where we see the most near-term pressure. Obviously, we know what's going on the bond delinquency side. We know what's going on the offshore side, but we can't underestimate the problems onshore. So Chinese lenders fell to a 2-year low on property contagion fears. Again, more onshore problems. Bank stocks fell on escalating risk. Non-performing loans triggered by refusals to pay mortgages could reach 83 billion US dollars. Chinese policymakers proved willing to cripple its junk dollar bond market to crack down on real estate, but these risks of broad social unrest and financial instability are a critical escalation of the property crisis. All of that is onshore, which is why it's hard to put this in and to put it into a nice little bubble and calculate it, which is why I think it's a lot of underrepresentation in terms of how this could go. But China is actively, again, look at the foreign reserves. They're dropping down. They're trying to take this money and invest as much as they can and prop up the economy, but you're dwindling your foreign exchange. So if you look at inflation, how comfortable are you with inflation going up, currency and what is backing the currency, which is the dollar, the euro, the yen, treasuries going down? Again, you're starting to see this fear, and this is going to be a line they're going to have to walk carefully, because as the foreign reserves come down, there's going to be, what is backing these assets? What is backing the currency? What is backing these projects? And as you take away a lot of these, what's the best way to put it? A lot of the collateral, that's when you start to get more fear, more contagion. And then the gap in the investment growth rates of Chinese services and industrial, you can see here that the industrial sector has been the investment growth and been the focal point. Now, the problem is the service side is the one that they've been trying to drum up, and now you're getting another huge pivot back to trying to drum up this industrial growth side, which we think is going to again yield a lot more problems going forward that will have negative implications on the underlying economy. Smallest increase in tertiary sector employment since 1973. If you want to understand what 1973 was, the end of the Great Leap Forward was right there, and then right after is where you started to see things come and get a little bit start to pick back up. But you're looking at employment problems. If you have high unemployment, you have slow spending, rampant lockdowns. This is a big problem, which is why you're getting such a focus on jobs and drumming that up. But then when you look at PPI, again, moving back and staying at these levels, it's still at the highest levels. Again, obviously outside of the spikes, it's still above where we were in 2017. Look at CPI. CPI is back to where it was in 2020. These are not good positions to be in when you're trying to drum up activity, when you're trying to stimulate. You've seen more debt coming in, more liquidity coming in. You're seeing more pressure. Again, they're creating this powder keg. So, but while all of this is happening, we have to think on the politics side. What is happening coming up? Xi looks firmly set for further elevation at the 20th Party Congress this fall, which is obviously happening in November, when his ideology may be placed on par with Chairman Mao. On Tuesday, one of the party's top theorists and former executive vice president of the Central Party School explained Xi's theoretical contribution to the party. Mao Zedong thought is the first historic leap in the Sinicization of Marxism. The theory of socialism with Chinese characteristics, which is Xi's component, has achieved a new leap in the Sinicization of Marxism. Xi, through thought on socialism with Chinese characteristics for a new era, has achieved another new leap in this Marxism. So what does that mean? Well, on the comrade side, he has lumped together the ideological contributions by Deng, Zhang, and Wu without specifically naming any of them. What that means, he is saying that only Mao and Xi deserve to have their names carved into the headline slot of the party's theoretical pantheon. So pieces like this are approved to appear in the most authoritative publication before a party congress, so show the direction of the political wind. So again, Xi is trying to solidify his hold on the party because there is underlying pushback. There is a lot of economic pressure, and he's trying to, again, position himself for growth over the longer term. So now when you start looking at, when factoring in core CPI is at 1%, automotive fuels is at moving to the highs, which is why they're hoarding gasoline and diesel, because automotive fuels are going up. But remember, it's still set by the incremental barrel, which is elevated. This is the Chinese problem. If they were to export their glut, that would help bring down the global market price, which would then bring down the last incremental barrel, which would then bring down their CPI of automotive fuels. But again, trying to explain that is very difficult. So, or at least to a communist regime. So when you look at the stats, the consumer price index came at 2.5. High inflation is one problem that Chinese policymakers don't have to contend with yet. The fuel price component of CPI was up 32.8%. The fall in PPI in year-over-year terms has been mainly down to a high base effect. Prices were up in the past 4 months and were flat in June. That is not a good situation to be in. Pork prices, a major component, are also on the rise again. They increased 2.9% month-on-month last month, having risen 5.2% in May. Officials have rushed to try and contain pork price increases, but again, but low CPI for now means that Chinese officials are not having to struggle the same way other countries are on a high inflation side. But this is symptomatic of how weak post-lockdown consumption is. So now you have to look at it. Is inflation, which is still a bit elevated, but is it not higher because local consumption is so bad? And if local consumption is struggling so much, what do we do about it? How is that structured, and what happens going forward? Which is why we remain very concerned on local Chinese growth. So core CPI, which excludes food and energy, increased by 1%, up marginally from 0.9. Prices in the service sector increased by just 0.2%. Meager price growth was in spite of the NBS services PMI rising to the highest in more than a year. Chinese officials may be tempted to pat themselves on the back by dodging the bullet, but low prices are indicative of bigger problems. So it's twofold. So you have inflation moving in some areas, down in others, but we know supply problems still remain. So if supply problems are providing only so much, low demand is the bigger issue, which is why we talk so much about slow retail sales and the slower consumer. Online sales slumped, again, feeding back to what we've been saying in terms of just not seeing the same type of volume. And you can see back through 2021, this is not just this current lockdown. This has been a perpetual issue when you look at retail sales, especially on the online side, where you're just not seeing this growth, which again, leading to what we've discussed on the slow, while monthly new loans obviously moved to the new highs. Cumulative year to date, remember they tried to pull forward some of these new loans. The question is, are they going to try to maintain this? And if they do, they're just making that leverage situation worse because they're forcing banks to lend, even though it's just a jobs grab, and there's really no concern of, well, is this a good bond? Is this a good loan? It's just generate jobs, we'll figure it out later, which is not a very good way to do business or economic growth. And that's when you start seeing the aggregate financing. And then when you take the cumulative side, we're just back to where we were in 2020. But the law of diminishing returns is real, because if you keep doing the same thing, the money doesn't go as far. So you need more of it to get the same reaction, until you get to a point where no matter how much money you throw at it, it's negative util or negative growth. And unfortunately, that is where we are approaching. So M1's money supply, while all of the growth is happening, you have to look at where M1 money supply is. It's still fairly muted for where it is, and it's going up. I'm not saying it isn't, but there's still, the PBOC is still cautious. So M2 moving up again, trying to balance that credit growth. But when we've been talking about that credit impulse, it's just trying to keep it stable. So they'll try to get a little bump, pull back. And again, it's very hard to create just a flat line in credit impulses. It's going to waffle back and forth. So you're going to provide a little bit of a bump on the M1, M2 money supply side, and then pull back a bit and trying to manage this while they're trying to look at ways to prop up the economy. And as you can see here, just how slow imports are on the Chinese front, and the problem that continues to point to, not only, again, coming full circle to what you could extrapolate from lower inflation, low local demand, and the issues on global exports. So now when you look at Chinese onshore and offshore property stock prices, the structural breakdown continues. And again, as we keep saying, on the onshore offshore side, there are a lot of problems that remain. Chinese consumption trends have been sluggish since the pandemic started. Retail sales, online retail sales, auto sales, again, all of this pointing to and describing what we've been calling out of that weak local consumption, and the failure so far of these different programs of dual circulation strategy, common prosperity, because so far we've only got lip service, but no real call to action. Now, the jobs is a step, but is it going to have the lasting impact they're hoping for? So Chinese lenders fell to a 2-year low on property contagion fears. That's only going to continue making it worse. And consumer confidence in the area plummets to the lowest ever. And I think that is really important when you look at how people are spending, how people are buying. It just isn't there. So now when we pivot to India, industrial production was expected at 20.8, came in at 19.6, slightly slower, obviously still good. CPI was expected at 7.1, came in at 7.01%, still over 7%, a lot of staying power there. But as we said before, we didn't expect another surge up. We have said there is a lot of staying power in this zone. And that's where 7 to 7.5% is where we believe India is going to live, which is going to, again, be very problematic for local consumption and the local consumer. Wholesale prices were expected to be up 15.63%, came in up 15.18%. Good, but again, still over 15%. Imports had a nice remain elevated. That's still strong. Exports continue to be supported. We still expect exports to remain elevated, especially as they're dumping as much gasoline and diesel into the market. They just announced that they did the windfall tax. Now they're looking to bring that down a bit, because I think they're realizing how much they need that money to come through, especially on the dollar front. So then when you start looking at foreign direct investment, outflows from India are increasing, and we think that's going to continue because, again, India's in one spot now, but the future looks concerning, especially as you have these slowdowns in global trade and inflation fears going up, which again is very much targeting India. So CPI, as you can see, just holding to the highs. We just see it holding between the 7 to 7.5%. India index of industrial production, still very strong, but below estimates, but again, still supporting some of this activity. But we do see this slowing down as exports continue to roll over. So obviously there's always a lot of Japanese data. We're just going to call out some of the important ones here, which is household spending, coming down a bit. But when you look at economic watchers for June, the expectation was for 55, came in at 52.9. Survey outlook was expected at 53.6, came in at 47.6. So again, you're starting to see that contraction and the concerns as we come into June. PPI was expected at 8.9%, came in at 9.2. big spike up, which is the biggest concern because, again, they are an exporting nation. So that PPI gets exported into the international market, and you guessed it, we're the ones that import it. So again, that's going to be a pressure to the upside in terms of inflation into the U.S. Now, when you look at slowing down, Japan's household spending is losing momentum. We expect this to be under pressure, but not to be a huge headwind, just to bump along and be fairly, just below growth as you get some of that slowdown on the consumption side as exports and other pressure continues. Japan economic watchers expectations are now fully contractionary. As you can see, Japan PPI, as we've been saying from the very beginning, stays at this elevated level. Not a huge surge up, not a drop. Just again, that pressure is going to remain. All the while looking at Korea, the full month exports continue to trend lower. When you look at global exports, again, Korea tends to be a leading indicator, and you can see here that the charts actually move fairly close to each other, and the trend has been down, and now you're getting a bigger rollover now with where it's going in the future. And we just think that, again, it's more of an indication of a slowing global economy. Not negative, but again, moving in the wrong direction. But inflation continues to be a big problem in Korea. So they went above and beyond versus what expectations were. It was for, most expectations were for a 25 to 50 basis point hike. So it's not a huge surprise, but they just went to the upper end of that number as they try to, again, get in front of inflation. So that's what we have for you on Asia. Hopefully this was helpful. If you have any questions, again, you can find us on the comment section or in Twitter, on my Twitter. So I'll be out of pocket next week. I'll try to answer things as I can. But we hope that you have a great rest of your day, and thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.